At Market Financial Solutions, we have a range of ICR tools at our disposal to boost loan size where appropriate and support our borrowers with their affordability concerns. In this video, we'll break down what these tools are and how our clients can utilise them. An interest coverage ratio, or ICR, is a ratio used by lenders to determine how well a borrower can pay the interest on their outstanding debts. It essentially allows lenders to determine how risky an investment or deal may be. Our range of ICR tools allow us to maximise loan sizes where possible and provide optionality for our borrowers. Our tools are there to help property investors and landlords overcome their affordability challenges regardless of whether they're refinancing, purchasing, or tackling particularly complicated investments. Generally, many lenders will do a rigid stress test and loan size calculation to ensure the rental income far exceeds their ICR requirement, whereas at Market Financial Solutions, we look at the rent income versus interest due over the initial term of the loan. Currently, we have three main options or routes borrowers can take to boost their loan size. In the first, we can roll up months worth of interest. So, at the start of the term for between 1 and 9 months, rolled months of interest are added to the loan and paid at redemption. This allows borrowers the time and breathing space to secure tenants, do some light renovations, improve their EPC score, or otherwise better their position. The ICR is boosted as we'll compare the remaining months of interest against the rent in the initial rate period. Option 2 is deferred interest. Here we can deduct up to 2% from the applicable rate. By deferring some of the interest due until the loan is redeemed, effectively using some of the equity in the property, the rent creates a higher ICR. So, borrowers will be able to increase the loan size so long as the resulting ICR remains 125% or more. This can also reduce monthly interest payments, which helps with affordability, potential cash flow issues, or, once more, allows investors to simply borrow more. The ICR is boosted as we compare the reduced interest payment to the rental income. The deferred interest itself is added to the loan and is paid at redemption. Finally, there is top slicing, option 3. This involves utilising surplus salary income, large savings, liquid assets, or portfolio excess rent to boost rental income. In simple terms, we'll factor in surplus income or wealth to top up any of the shortfall in the rent needed to secure the loan. Our underwriters may be able to use this wider wealth to assess the borrower's resilience against rental voids, maintenance issues, or unexpected costs. We can allow up to 20% of the monthly rental income to be covered with clear evidence. So in practice, say the monthly rental income is £2,000 a month, we can consider the rent as £2,400 with top slicing for ICR purposes. The right option will depend on the borrower's circumstances and preferences, which we worked out at length with their dedicated underwriter. Also, a combination of all three options could be utilised to boost loan size as well, where appropriate. To illustrate, say a borrower wants to raise at least 65% LTV against a buy-to-let property worth £1.35 million, generating £5,000 in monthly rent. They plan to use the funds for a light refurb with the aim of improving the property's desirability to put a deposit towards another purchase. They're confident about their rental potential and value growth for a long-term remortgage down the line, but they've struggled to find a lender able to lend anywhere near the required LTV or amount. Let's say in this case they'd need a buy-to-let loan of £845,000, but are only able to attain £589,000 without loan boosting efforts. Option 2, deferring interest, would allow us to boost the loan size and lower monthly costs, but it still wouldn't be enough to meet the £845,000 target. By incorporating rolled interest, option 3, we could boost the net loan size further while allowing the borrower to benefit from being free of repayments during the rolled months. While this would get us closer, it still wouldn't boost the loan size sufficiently enough. Fortunately, option 4 would get us there. By rolling and deferring interest, we could maximise leverage and deliver the £845,000 required. The general proposition behind this is that with every case we come across, we try to find a way to say yes. We'll always embrace flexibility and optionality with our buy-to-let offering.